Hey traders, welcome to our Sunday weekly. I had nothing better to call it than the Raghee Report show. Great to see everyone kicking off a brand new week, taking a look at what kind of market we are dealing with so we can better prepare for Monday. Not at 9:30 a.m., but on a Sunday evening when everyone else is still thinking about, well, whatever non-market thing they are. Nothing wrong with that. Nothing wrong with that. It's just that on a Sunday night, I like to start clicking on sort of at least where could the opportunities be in the upcoming week, or as my husband lovingly calls my Sunday evenings in front of the computer, who's got my money? I think that's what he said. He goes, what is this you're doing? I said, the who's got my money hour? I said, yeah, pretty much. Who's got my money? So I'm looking at the symbols that are going to be hopefully where trades are going to be happening, where the opportunities are going to be happening. That's what Sunday night's all about. And that frees me up to sort of chill, enjoy some coffee, and not feel so rushed and pressured on Monday morning. All right. Because I've got my, who's got my money hour that I do on a Sunday night. All right. So as always, gang, we want to prepare for the week by taking a look at the economic calendar. So I'm going to open that up right now. And two calendars, really three calendars we can take a look at. One is the Forex Factory calendar. I'm a big fan of this calendar. And this one is how I can see where all those red hot zones are. So scan through the week, and the first thing that you're going to notice is CPI, core CPI on Wednesday. Inflation data is always going to be a potential huge needle mover. PPI on Thursday, another huge potential needle mover. And then we have consumer sentiment on Friday. So that really leaves Monday and Tuesday really in the typical post non-farm payroll week, but usually a slow data week. Monday and Tuesday, we get a bit of a reprieve from red hot zones. But come Wednesday, it's game on. So we'll be keeping an eye on that as we go through the week. All right, the next thing that I want to do is take a look at, let's see here. I want to take a look at bear with me. There we go. Trading economics calendar. Why this calendar? Why do I concern myself with this calendar if we have Forex Factory? The reason is, and the reason we want to keep an eye on the trading economics calendar, and usually I want to eliminate all the other countries but the US, unless you're trading currencies of other countries or maybe some emerging market ETFs or ETFs from other countries. I want to keep an eye on this one because it does a better job of letting us know when there are different FOMC speaking engagements. And so far, nothing. So sometimes Forex Factory omits those, and Forex Factory is great. It's going to cover 80% of what you need. But when you want to find some of those FOMC events, it may not be shown on Forex Factory, trading economics. And then lastly, I will take a look at the Estimize calendar for earnings. All right, let's open up the daily time frames here. Take a look at what we've got to kick off Sunday. Look, we are just levitating up at an overbought resistance level. This is not a market that's screaming through the 200. In fact, this is where we are overbought. Why would I use jargon like that? Because we're still in a non-trending environment, right? We're not looking for breakouts quite yet because we're not really compressed looking for that expansion. You can see the same thing on the NASDAQ, just kind of stuck at the ceiling of an overbought stochastic, the 200 exponential propulsion. Previous resistance is pretty much mapping forward to current resistance. So take a look at early May to where we are right now, kind of in the vicinity. Same thing's happening with the ES. We get into the YM. Very similar situation, right near that 200, overbought stochastic, all in a neutral environment. And then finally the Russell, which doesn't have to move like the others because the weighting, the composition of the Russell is completely different. It's not a high concentration weighted index. It's not really sharing any of the sectors and components really in any significant way with the NASDAQ, the S&P, and the Dow. So it can do its own thing, but take a look. It too, take a look at that Darvis level. Take a look at the overbought stochastic. Take a look at the neutral but slightly bullish market. If there is a leader here, if there is an index that's starting to show a little bit of strength, we don't want to do this with guesswork, right? And I don't just want to say because I said so. Take a look at the structure. We are double green on the Momo and trend, which means that 8, 13, 21, and 34 are showing early looks into what could be a stronger market. The only edge in this environment that I believe the Russell has is likely the US dollar remains fairly strong because we're leaning towards a slightly more hawkish end of an expected range for the target rate probability. What does that mean? Well, we have about 3 different potential outcomes for target rate probability for the Federal Reserve come December. If we're in the middle, it's pretty much where we're not really too concerned. It's pretty much a sweet spot. If we're a little bit on the more less hawkish side, if we're a little bit more on the more hawkish side, there's really kind of a baby bear, mama bear, papa bear type scenario there. And right now we're leaning towards papa bear. And that means that we're going to have a little bit more hawkishness. That's the expectation. The dollar is going to be a little stronger. That slight edge, the dollar, well, relatively speaking, domestic small caps are not going to track with that strength, but the expectation is a strong dollar doesn't do international companies like the ones in the NASDAQ, the Dow, and the S&P any favors. It certainly does not hurt the domestic small caps. And that's where sometimes you'll notice the persistent US dollar strength. The Russells, not that it's correlated in that manner, but understand the causation. Sometimes that will be the way that plays out. All right, gang. So let's jump into your questions. This is what I've got in my notes. Again, kind of the Raghee report mentality of let's prepare on a Sunday so we're not scrambling on a Monday, and we can kind of relax and wait for the open to come to us. And we've already got a pretty good idea of what we're expecting. All right. So first question, John asks, how might we set up Tesla as a reaction to the Inflation Reduction Act? Whatever that may or may not do is going to be volatility. That's it. It's going to be a volatility conversation, right? If it's a volatility conversation and it sends Tesla, which is a double green uptrend, lower, especially towards the 21 exponential propulsion, towards the 34 EMA wave, essentially towards approximately 815 to 775, 800 might be a really good sweet spot. That's going to be a buy the dip. It's a buy the dip of a fairly fresh uptrend, John. But again, don't get too hung up on the actual act as more so than the catalyst itself. Because remember, just because certain events happen, don't guarantee a reaction. We can see a reaction in Tesla as of Friday. Clearly, this was something that was on traders' minds, perhaps. But nonetheless, there's your initial move lower. And if it continues to move lower, there's an opportunity. If it moves higher, I'm not going to chase bullish momentum. So it really depends on where on this chart from a price perspective does Tesla land. Again, every trade has to begin with, the underlying market structure. After that, a trade really is what zone, what level am I going to enter at, right? Where is the entry zone? And that is a price level. And that's the one I'd be looking at, John. Hey there, Nick. What are my thoughts on the usefulness of trend lines? I don't think I've ever seen you use them, nor will you see me use them, Nick. Early in my career, like everybody else, I drew trend lines. But now, and this has been for probably a good 10 years, I have a saying, friends don't let friends draw trend lines. I know it sounds like heresy. Hear me out. The more that we use subjective tools, I automated trend lines on a platform many moons ago, probably 20 years ago. I didn't automate them. A programmer did. And I used those tools. And it was part of a package that I used to use on eSignal back in late 90s. And this programmer, I asked him, I said, how did you automate this? This isn't something that I've seen done this effectively. And he went through the 4 different things that he looks for to draw a major or minor trend line. And it had everything to do with how far back in the look back are you looking? How many touch points are along the line of that trend line? What's the distance between each touch point? And then finally, how close is that trend line to current price? And those 4 factors, unless you're going through a very process driven approach. And look, I've never heard any other trader talk about those 4 factors. He was the first one. I adopted that because it made perfect sense. What is the process by which I draw a trend line and would differentiate between major and minor trend lines? So that's the way I did it for a long time, but that's really difficult to teach. That's a lot of experience. That's a process that most traders simply won't do. If for the most part, trend lines are reduced to sort of a dot to dot on the chart, and they end up being ridiculously subjective. Imagine if someone's drawing a trend line on this chart, probably the one that's going to come to mind is a downtrend. If they were, and maybe this uptrend here, if they were looking at it from this perspective, it would only be the uptrend. So a lot of why we draw what we draw, support and resistance levels included, which by the way, I've automated as well. I've automated so many of these tools because it's the easiest way for me to reduce the learning curve for new traders. It's the easiest way for me to expedite my analysis and to increase accuracy. We're able to do both those things when we automate our processes. And anytime you work with a programmer, a good one, who's asking, what do you need this indicator or this system to do? They're going to walk you through a lot of detailed questions. And that was just the one for something as simple as trend lines. So no, I don't draw them. I don't actually encourage drawing of them. I think usually we're deluding ourselves when we do draw them. And you might think, oh my gosh, Rag, that's crazy talk. That's okay. I think you'll find Darvis 2.0 a support and resistance process that relies on previous swings, right? Minor highs and minor lows is going to not only outperform trend lines, but be unbelievably more accurate. Okay, so I hope that helps. It explains that and tells you my rationale. That being said, if you're using trend lines to great success, if they give you confidence and clarity on the screen, go for it, right? But I do not use them. Yeah, and you won't see me use them. Thank you for the question. Hey there, Alan. Did Berkshire Hathaway earnings report hit my radar? No, I don't. I don't really trade Berkshire, Alan. I invest in Berkshire, but I do not trade it. If it did, and it's one of my long terms, any feedback? So if it's a long term, the only reason and that immediately takes me to the weekly time frame. So if I'm looking at Berkshire and I'm looking at the weekly, the only reason earnings are even remotely interesting is because it might become the catalyst I need to get a fill. But no, for the most part, earnings and longer term weekly setups really are not ever going to dovetail for me. It might be enough sometimes if it's a dramatic reaction to earnings to be helpful, but for the most part, it usually isn't. So daily timeframes, of course, intraday timeframes, but since I don't trade Berkshire, I rather look longer term time frame horizon, or I should say, I don't swing trade it, I don't day trade it, but I will position or invest. It doesn't really concern me in terms of earnings, not usually. Now, where it would be interesting, Alan, if I am concerned and I want to keep an eye on XLF and other stocks heavily weighted within XLF, I really do need to keep an eye on Berkshire because Berkshire is the number one weighted stock in the XLF. And that individual boat could absolutely have a temporary effect on the tide. You bet. You bet. All right. Next question is CCL. Industry rose on Friday. Does it look like a pullback? No, my friend. Look at the structure. There's nothing but really barely neutral within a sea of red. So pullback would insinuate that we have an uptrend. No, my friend, not even a little bit. So John, yeah, I would not look at CCL. This is Carnival as a pullback at all. Look at the structure. So no, my friend, I would not. QCOM. Daily long, double green, buy the dip. Absolutely. I am Groot. Look at the last dip. You want something that looks like either, well, the low that you saw on 728, or ideally the candle on 729. You want something that looks like 729 dip, trading down into the wave is that dip. So I do like that potential setup. All right. Okay, next up is Euro versus USD 6E. Oh, sure. 6E is, look, dollar is still bullish, but as I've been saying for a couple weeks now, the dollar's best days are behind it. And that means that the euro's probably not going to crush parity and keep going. The reason for that is the dollar's still going to be strong and the euro's still going to be weak. But in terms of the parabolic and the acceleration to the downside in the euro and the parabolic moves, the accelerated moves, and the rally to the upside in the US dollar, that was while the US dollar was still rallying because of a fairly fresh rate hike cycle. We're in the mature end of that. We already know, based on Fed Fund futures, where the target rate probabilities are going to land us. The fact that it's known then starts to reduce new buyers coming into the market, unless the Fed Fund futures start to look at a Fed target rate probability at 4.0 or greater, 4% or greater. We're really looking at euro, yen, pound not making the same kind of strides to the downside. And that means a dollar index is not going to make the same kind of strides to the upside. And that means that while those trends are still in place, we have to have far closer initial targets and far less ambitious targets, because these are slowly going to transition to chop. Bearish chop for the euro, bearish chop for the pound, bullish chop for the dollar. They're not there yet, but that has certainly begun. Okay. And that has to do with central bank monetary policy. It has to do with the fact that the euro is going to benefit from a fairly fresh transition to hawkish monetary policy and action. And that is going to start to erode some US dollar strength. All right, next up, Trader Momo asks, so the line in the sand is the previous session close, correct? What is the Darvas line in the sand on the chart? Yeah, review the chart. Trader Momo, I'm not going to start to teach classes in our Charts and Coffee or our weekly, but take a look. Here's a couple things you can do. Number one, review the class. I mean, obviously, if you have the class, I'd highly recommend reviewing it. And then two, use the Darvas 3.0 and the arrows there to help you identify the minor lows and minor highs. And then you're going to use the candle that the arrow is above or below. That's really where the Darvas line in the sand begins to get drawn. Okay. All right. Next up, Rajesh asked, do I trade Forex or other stuff? All of the above. All of the above. Options, ETF, stocks. I don't trade Forex as much. Mainly because in the US, it's not a market that really is a very popularly traded market. I kind of go where there's interest. And if there's interest and it's something that I've been trading for a very long time, usually decades, I'll add it to what I teach and what I trade. And that means futures, day trading futures, options on stocks, options on ETFs, day trading options on stocks, day trading options on ETF. I love currency futures. They're very liquid, incredibly liquid, much more liquid than they were just even 10 or 15 years ago. And so while I love Forex, it's not something that I do a lot of here at Simpler. All right, next up is, let's see. I think I have a slightly Raghee Horner University. Get your 4-year degree in chart work. Yes. Yes, that's hilarious. Okay, next up is any thoughts on high yield? Sure, HYG. HYG. All right, taking a look at HYG. It's just flirting with. It looks a lot like the Russell, doesn't it? It looks a lot like the RTY. RTY is going to map to the IWM. Barely barely giving us a very fresh, bullish look. But hey, it's the first time we've been a double green uptrend since this very brief period of time back in September or even July. So be cautious because this is akin to very fresh traction. We're not going to presume it's up, and away from here, but clearly the bulls are starting to gain a little bit of traction. It'll be much more convincing when we're north of the 200 exponential, which we are clearly not yet. All right, which we are clearly not yet. However, we are seeing a little bit of strength. So it would be, if we can persist into next week with double green, we could start to consider buy the dip. Same thing goes with the Russell. We can start to consider buy the dip. There are some places that you're going to notice that as it seems a little bit more risk appetite's making its way into the market, high yield, small cap. I don't know if J&K is in the same boat. Yeah, KRE, not quite. We're starting to see some corners of the market show very fresh double greens. And by the way, if you're a member of the Sector Secrets Mastery, you know that on Tuesday, when we did our longer term view, we built out a fairly sizable watch list of individual stocks that were leaders within their sector. They were double green leaders within their sector. And so there are a limited but fairly decent amount of double green uptrends that are emerging out there. We need to be discerning and we need to be cautious, but it's starting to look like, for some time, we've been talking about this since, gosh, it's a month ago, really. What is today? The 7th? Actually, a month ago today, in July, I did a video. And if you haven't checked it out, you can check it out right here at the Simpler Trading YouTube channel, where I talk specifically about the light at the end of the bottom. Calling a bottom doesn't mean we're going to see nothing but an uptrend and higher highs from here. That's a very illogical but common belief about anyone calling a bottom. Number one, I don't call a bottom. Bottoming processes are exactly that. They're the chop that begins at the end of a downtrend. And on the 7th, I said, this is what we're getting. Why? The underlying market trend, the technical structure, the price-based technical structure of the market was indicating that. Macroeconomically, that was syncing up with price. And so this is really the sort of early stages of the chop starting to encourage more curiosity to the long side. And you'll see certain corners, small, but certain corners of the market start to gain some traction. We can see that. We can see that, to your point with, say, HYG, or the earlier question about the Russell. We can see that when our trade flags go green. We can see that when our multi-trend goes green, as the 8, 13, 21, and 34 EMA start saying, you know what? We're getting bullish structure. We're getting traction. It's time to start thinking less neutral and more, say, bullish neutral about some of these corners of the market. All right. Okay. Next up. Thanks for the question, Miles. Do I think the ES will pull back next week? So one of the things I teach consistently is prediction, no. Process, yes. Always process over prediction. So, Johnny, that's a prediction conversation. I don't know that. Nobody knows that. Now, is there a chance that this is an overbought market? So that answer is yes. If it is overbought and we break support, we'll head lower. But those are all ifs, right? So I don't know. And frankly, nobody does either. However, if we look at the structure, and this is where we've exhausted before, you can see where we are now. There's a pretty good chance this is where we stall. That's the first step. If we stall long enough, it could encourage sellers. If it encourages sellers, we're going to start to break the lows of certain candles, right? We'll break the low of support levels, right? We'll break that support. And as we break that support, oftentimes that's going to encourage bearish momentum, selling pressure. That's how the market always works. It's phases of opinion. Opinion turns into momentum. Momentum could, if it persists, turn into a trend. So it's just as look, we could bust up through 4,200 as well. The key to trading is not where the market is going. One of the things I try to teach traders is, if I put a target out there, like 4,200, which is meaningless, or a target out there like 4,100. Targets are absolutely clickbait, right? Because a target without an entry and a stop loss It's just meant to grab your attention and not give you anything useful. It's an empty calorie. It's the potato chip of trading, right? It's just the empty calorie of trading. So we could go to 4,200, we can go to 4,100. Neither one helps anybody, including myself, unless we know where we want to enter from and how we can control risk. So I don't know, but that's the way, if it does happen, it would have to happen, right? Regardless of analysis styles, that's the way it would have to happen. All right, next up, who's got my money? Yeah, that's something I think my husband started saying a while back. Who's got your money? That's what he comes into. Who's got your money? Because I'd be scanning the market for stuff. Mm. Oh, I wasn't apologizing. No, not at all. For being an opportunist, never will, never will. Can't decide if cat is a good long. Let's take a look. Again, starting with structure, right, Chris? Starting with structure. And thanks again, everyone, for all the questions. Good stuff. I mean, I think we have to start. Some traders I can tell may be new to my style. Look, gang, the only thing anyone on this side of the microphone and camera can share is what they actually do. And that is always what I will share with you all. I'm not looking to say the popular thing. I'm looking, hopefully, to share with you the clearest and the truest thing that I know has worked for me, not this year or last year, but for decades, right? What are these principles that my trading career has been built upon? So hopefully that is what comes across. Cat, I don't have any opinion on cat. Probably still a little bit more bearish than anything. So Chris, yeah, I don't have anything on cat. In other words, I don't really have an edge. What's the edge? It's in the middle of a range. Maybe because we pull back 50%, we bounce off the 180, 181 area. I don't know. That's just sort of grasping at something to do rather than really being compelled, attention grabbing, compelled to do something. So I don't have anything on cat, my friend. No, not at all. Not at all. Can't say it's grabbing my eye. CFLT. No, I mean, I can't do anything at current prices, Colin. It's an interesting move, but again, I'm not gonna play momentum. ASNA. ASNA. It's not pulling up. So yeah, nothing I can do with that. Nothing I can do with those. Well, I can't even pull the other one up. Next up, Alan asked, donkey for a possible squeeze play. Well, the precursor for a squeeze has got to be a neutral market. It has broken out of the Darvis. If you need to know the specific date, Alan, it broke out on the 3rd. It did break out on the 3rd. Now, does that accompany a squeeze? I do not know, because I don't actually play momentum. It's not a style that I particularly like. However, if you're looking at a compressed Darvis, I like to see as many blue grab candles as possible. Narrow Darvis, and that breakout was the 3rd. That was the 3rd. All right, gang. And just like that 30 minutes flies by so fast, gang. Thank you, as always, for being a part of the weekly Raghee Report. Again, thank you for the questions. Thank you for being open-minded to ways that are probably different than what you hear other traders talk about. Remember, gang, give or take, most traders do the same thing. They look at the market in the same way. And sadly, most traders do not consistently do well in the market. So think about not being a contrarian to trends, but being a contrarian to conventional dogma, conventional market wisdom. It's going to serve you a whole lot better. And thank you for being open-minded. I really appreciate it. I tip my hat to you all, because clearly, if you're here, you're ready for something a little different. You're ready for something a little new. And not everyone wants to do that, gang. A lot of people just want to stick with what everyone else is doing. Well, then that's going to get you the results that everyone else is getting. So I absolutely admire you all for taking the time on a Sunday to join me. I'll see you tomorrow for Charts and Coffee at 9 a.m. right back here at the Simpler Trading YouTube channel. Be good to each other.